Hi everyone, Josh Gilbert here and welcome to Stock Break, where I give an in-depth analysis on public companies in under 5 minutes, breaking down their fundamentals and potential valuation. So let's dive in. Hello everyone and welcome back to another episode of Stock Break with me, Josh Gilbert. Today we're going to be looking at DoorDash. Before we dive in though, a quick reminder that this presentation is for educational purposes only, should not be taken as investment advice or a recommendation to buy or sell any financial instruments. So let's dive in, let's get started. DoorDash was founded in 2013 by 4 university students from Stanford. The business is currently located in 25 different countries. They connect consumers, delivery riders, and merchants. Essentially, they are called dashers. They pick up, they deliver orders. Think groceries, think your favorite takeaway. They currently make about 90% of their revenue in the United States, but the business is aggressively expanding overseas to diversify its revenue. They've got strong marketing campaigns and acquisitions. I'm sure you would have seen their marketing campaigns throughout wherever you are in the world. The business is listed on the NASDAQ. It went public in 2020. Shares rose by more than 80% on the first day of trading. Shares have since settled back around about $104, sitting below the record highs that we saw back in early 2021 of around about $240. But the company is growing at a substantial pace. The number of orders have increased by more than 55% in the last 2 years, and it has continued to flourish since the pandemic. And what's that seen is it's seen its market share in the US grow to over 60%. Which may surprise a few people. Main competitors include Uber and Grubhub in the US. Uber, of course, needs no introduction. By far the most feared competitor, has high profitability and therefore the financial capability to innovate and grow. But despite a lower market share, Uber's food business still isn't seeing the same growth that DoorDash is experiencing, which is really interesting in my view. The pandemic, as I said earlier, accelerated the business, but they haven't rested on their laurels. The company has moved from strength to strength, and that is reflected in the revenue growth that we have seen. Its advertising business has gained traction, and its Dash Pass subscription service has continued to drive higher order frequency and order values. And in 2023, total order value increased by 25% and is showing no signs of slowing down. At the start of the year, they reported solid Q1 earnings, showing improvements in gross margins, reduced operating losses, and increased cash flow. And DoorDash currently has about $4 billion on its balance sheet with no long-term debt at the end of 2023. That's a pretty impressive feat for a company growing at such a rapid pace, and free cash flow increased in the first quarter as well. Despite this progress, though, they are still operating at a loss, but profitability is close. Losses last quarter reduced by 86% year over year, and the market is eyeing Q3 for that first profitable quarter. Expansion overseas, though, isn't cheap. The company spent over $500 million on sales and marketing in Q1. And over $270 million on research and development. This poses a risk if sustained growth isn't achieved. The market didn't like it in Q1 and actually sold off after the result, despite what was a pretty decent report all in all. But profitability is close. Order value is still growing at a solid click, and its balance sheet is primed for what I would say is more acquisitions, which could signal future growth. You are going to pay for some of that growth though. Shares are currently trading at 45.5 times forward earnings, looking to that profit that's on the way. But if we have a look at the Guru Focus Value Tracker, it still says that DoorDash is actually modestly undervalued with profitability just around the corner. So maybe the market is underappreciating the growth of the food delivery market. But again, I think there is no margin for error. We saw that in Q1 when shares sold off, so it has to deliver. If it stumbles along the way, I think the market will punish it. But with an excellent runway for growth, analysts are bullish. 24 buy rating, 17 holds, and 0 sells. So as I said, DoorDash dominates the US market, and the company has a number of clear catalysts for ongoing growth, rapid international expansion, a growing advertising business, and of course, that profitability that is on the way. Competition and regulatory scrutiny pose ongoing challenges, but DoorDash has managed these headwinds very, very well in recent years. They will need to keep delivering in more ways than one, but future prospects look promising for shareholders. Thanks for watching Stock Break. Let me know in the comments what you think of DoorDash, and we'll see you here next time.